Today, we're going to talk about some of the pitfalls of S corporations. This is the information that is not put out about S corps most of the time when I see people talk about S corps. So, what are S corporations? Well, I talked about the different types of entities in a previous video. I'll put that link in the description. But an S corp is an election you make to have your entity taxed under the tax code of subchapter S of the Internal Revenue Code. Now, there are some benefits of having an S corp because it will reduce your self-employment tax. Let's start with that. That is the biggest benefit of an S corporation. It will reduce your self-employment tax. And we're talking specifically about FICA. FICA is the Federal Insurance Compensation Act. So when you apply for unemployment, your employer pays into FICA. If you want Social Security when you retire, and you want Medicare when you're disabled or retire, this is the tax that is paid into those systems. Social Security, Medicare, federal unemployment tax, and then your state will have what's called state unemployment tax. And some states will have more than just unemployment tax. They may have compensation insurance, but regardless, at any rate, each state has its own little system for payroll tax, something like similar to FICA. That is one of the biggest benefits of having an S corp. So what happens when people have an S corp if they know they can avoid self-employment tax? Well, the way you avoid self-employment tax is by not paying yourself a salary. So think about this. You have $100,000 in profits and you didn't pay yourself a salary. If you have $100,000 in profits and you are not taxed as an S corp, you don't elect to be taxed as an S corp, you're going to pay 15.3% on that $100,000. So that's going to be $15,300. You're going to pay that in addition to paying your federal income tax. So at $100,000, you're probably going to be, if you're single, you're probably going to be in the 22 to 24% tax bracket. If you're married, you're probably going to be in the 12% tax bracket. So you're going to pay an additional, 22 to $12,000 in federal income tax. So we're almost at 50% tax when you have a business. So what the S corp does is say, hey, you know what? If you pay yourself a salary and that salary is reasonable, then you don't pay self-employment tax on your profits. Again, that is the big benefit of an S corp. And whenever I see things on YouTube or TikTok or Reels and all these shorts, they talk about the great benefits of the S corp. But the problem is they only talk about the upside. They don't talk about the downside. And I see the downside all the time. What is the downside? Everyone hears that, hey, if you have an S corp, you're going to save money in taxes. They don't understand why they're going to save the money in taxes. They get an S corp and then they shoot themselves in the foot. How do they shoot themselves in the foot? Number one, they don't take what's called reasonable compensation. And we just talked about that. So here's from the IRS website where they talk about what reasonable compensation is. And as you would imagine, the definition of what reasonable compensation is, it's very vague. It's intentionally vague. Because if the IRS gave a specific definition of what reasonable compensation was, then everyone would use that specific definition of reasonable compensation and they would do nothing else. So if you leave it intentionally vague, you leave room for people to pay more in taxes. That's not what the tax code says. That's just my opinion. Hey, I'm so afraid that I'm not going to take reasonable compensation that I'm going to pay more in reasonable compensation than I actually should. Then the IRS is going to collect more in taxes. The opposite happens too. People pay less than they're supposed to pay, and they intentionally pay less than they're supposed to pay. So now that leaves an opening for the IRS to come in and collect the taxes that they should collect. Because if you pay yourself less than reasonable compensation in an S corp, You're technically violating the law because you're not paying enough in taxes. Now, if it's intentional as opposed to an accident, those that bumps you into different areas of the law, whether it's criminal or not. Having said all of that, you have to take reasonable compensation if you have an S corp, if you take any compensation at all. So that's the other thing that people miss when we talk about the S corp and compensation. If you don't take any money out of your business, you're not required to pay yourself a salary because that's how the rule ultimately works. You must pay yourself a reasonable compensation before you before you take distributions. What are distributions? Distributions are, hey, I need something for myself, and I had this business to make money for me to go buy stuff I want for myself. So I'm going to take money out of my business for me. And that's just you going to the ATM or doing a Zelle transfer to yourself or writing a check to yourself or you buying something, excuse me, for yourself out of your business bank accounts that is personal in nature. Those are all distributions. And they generally are not taxed when you pull them out of the business. And so that's the upside. But before you can do that, you have to have you have to take reasonable compensation. And as I've mentioned in other videos, there are generally court cases around that. So here from the IRS website on reasonable compensation, you can see there are tax court cases when we talk about reasonable compensation. So this stuff always gets litigated. So number one, you have to take compensation for your S corp. It's got to be reasonable. How's reasonable defined? The IRS doesn't define it. They give you a bunch of metrics you can use. But one of the things that is not reasonable is what percent of distributions did I take out in relation to my gross income or my net income. That's not how you define reasonable compensation. Nowhere in the code does it talk about, or any of the guidance does it talk about a percent method. The question becomes, if you went to court and a court asked you, hey, taxpayer, hey, CPA, tell me how you defined what reasonable compensation was on your tax return. And if you said, well, I just took a percent of my distributions and my net income, and I believe that was reasonable, that's not consistent with the guidance that the IRS has taken out. Because there's not a way, like, I don't know how you defend that. So the only way that would pass muster in a tax court, in an audit situation, is if you paid more in compensation than you were supposed to pay. The IRS isn't going to care if you pay more in compensation or not, because you paid what was reasonable. You paid in excess of what was reasonable. What is the point of all this stuff? The point of all this is I want you to understand the complexities of S-Corps and how it's not as easy as what you see on different channels. It's not. Here's another thing that is not discussed with a lot of times. Your fringe benefits of an S-Corp are taxed. One of the fringe benefits is medical. Yes, you do get a deduction you get you get an adjustment to your income for your premiums for your medical insurance, but you're still going to get taxed on it. It needs to show up on your W-2, and you're going to get taxed on it. And other fringe benefits you get taxed on. And some fringe benefits you can't take, like life insurance for the greater than 2% shareholder. These are all things they don't talk about. Okay, so what is the bigger issue I see related to S-Corp? Let me take a step back. I want to talk about this S-Corp thing again and the reasonable compensation. So the FICA limit is $176,100 in 2025. If you have an S-Corp and you pay yourself $176,100 in salary, then you're really not any better off than if you didn't have an S-Corp and your profits were $176,100. $100 because you're going to pay the same amount in self-employment tax as if you didn't have the S-Corp. But that's not really what I'm concerned about. What I'm concerned about is when people make the S election immediately. They hear, and I see this a lot, and I'm seeing it a lot more now than I've seen in the past. You start your business off and you immediately elect to be an S-Corp. That is dangerous because if you don't have any profits and you don't have enough money to put back in the business before the end of the year, you're going to get what I call the double whammy of the S-Corp that people don't talk about. What's the double whammy of the S-Corp? Number one, if you don't have enough basis, and let's just keep that definition short because it can be super complicated, but basis is equity, is a way to look at it. If you don't have enough equity in your business, then two things happen when you have an S-Corp. Number one, your losses suspend. What does that mean? You can have $50,000 in losses in any given year for your S-Corp. And if you don't have any basis or equity, you cannot take those losses. They suspend and they carry forward. So let's say you're married and your spouse has $50,000 in income and you have $50,000 in losses. If you had equity in the business, if you had enough basis to cover those losses, you could wipe out your spouse's income with that $50,000 in losses. However, if you don't have enough basis in your S-Corp, and we look at the exact same scenario, in a year where you have $50,000 in losses, then you're not going to be able to wipe out that $50,000 in income from your spouse because those losses are going to suspend. So what does that mean from a practical perspective? You probably got loans to sustain yourself if you had $50,000 in losses to sustain that business. Or if you had a cash reserve, you chewed into that cash reserve. So you didn't have enough equity to take those losses. Guess what else happens when you have those losses? Your distributions get taxed. They get taxed at capital gains tax. And if it's your first year, they're going to get taxed at short-term capital gains rates. So now you're going to have a loss you can't take, and you're going to pay taxes on your distributions that you take out. So see, this thing can go sideways really, really fast. Then what ends up happening usually is someone comes to me after January 31st and say, yeah, I elected to be an S-Corp. It's March. We need to get this S-Corp done. And my immediate response is, did you take compensation for yourself? Because it looks like you took out distributions. Huh? What are you talking about? Reasonable compensation. Now you didn't file. Now if you're gonna file that S-Corp and you took distributions out and you don't have reasonable compensation, you're at risk of audit. And the deadline to file your W-2 has passed, January 31. And the deadline to file your quarterly taxes, your 941, has passed. Your 990 has passed. The deadline for that's going to be January 31st. So your 941 is passed, your 990 is passed, your state unemployment tax, SUTA, has passed. So now you got all these penalties and interest for failure to file. Then you got failure to deposit penalties. This thing it just keeps adding up. It keeps adding and adding and adding and adding up. But you saw somebody on YouTube said you can save a bunch of money in taxes because you're an S-Corp, and then you immediately elect to be an S-Corp, or you pay a lawyer to have you elect to be an S-Corp. And most lawyers don't know tax. They will tell you they hated their tax law classes when they went to law school. All lawyers have to take a tax class when they're in law school. But most of the lawyers avoid tax law because tax law is so crazy. Again, the accounting profession doesn't get the respect it deserves because we do law, accounting, finance, and a whole bunch of other stuff. So again, this stuff is complicated. It is complicated. It's not easy. You can't just read, a couple of sentences on an IRS website and think you have it figured out because there's all these other factors that are involved. So I'm going to reiterate what I reiterated from the other thing. When you have an issue that you see online, call a competent professional and ask for at least pay for an hour or two of their time and have them walk you through how this applied to you specifically. But this whole S-Corp thing, I have an S-Corp. I like having an S-Corp. It's great when you do it the right way. But there's too many landmines that you guys can step on that you're not aware that exist. So S-Corp is great. It's not the magic elixir. It's not a silver bullet for tax planning. What is the best way to get tax planning? Find a professional, hire the professional, pay them for their time, and you'll be great. You'll be all right.